Welcome back, everybody, to another deep dive. Today, we're going to be talking about value investing.
Oh, yeah.
And we're going to be looking through the lens of the OG value investor.
Yeah.
The godfather.
The Godfather.
Mr. Benjamin Graham.
Absolutely.
We've got a lot of cool sources for this one.
Yeah.
Articles, book excerpts. We even have some of Graham's own writing.
Nice.
And what we're trying to do today is just give you a really good understanding of what his main principles are.
Sure.
And how they can help us navigate today's market.
Yeah. His insights, they really stand the test of time.
Mm-hmm.
You know what I mean?
Yeah.
Decades later, and they're still so relevant.
Okay, so let's jump right in. First things first, what is value investing? How did Benjamin Graham define it?
Right. So value investing, it's a strategy that's, laser focused on finding stocks that are trading for less than their intrinsic worth.
Okay.
So think of it this way.
Okay.
A company has an intrinsic value, right?
Mm-hmm.
It's true worth. But the market, often driven by emotion, slaps a different price tag on it.
Right.
And that difference, that gap between the intrinsic value and the market price, that's where value investors see opportunity.
So it's like you're finding a treasure
Yeah.
at a garage sale.
Exactly.
You're seeing something that's worth way more than what the sticker is.
100%. And Graham actually had this brilliant way of personifying the market's irrational behavior with his concept of Mr. Market.
Okay.
Imagine Mr. Market as this, fickle character swinging wildly between, fits of optimism and pessimism.
Mm-hmm.
Every day he offers you prices for your stocks, sometimes sky high, sometimes dirt cheap.
Okay, so how do we make sure we don't get caught up in those swings?
Yeah.
Because that seems like a very emotional way to be investing.
You're absolutely right. It's a real challenge.
Yeah.
But that's where Graham's wisdom comes in.
Okay.
He tells us, don't let Mr. Market dictate our actions.
Mm-hmm.
We shouldn't buy just because he's excited or sell because he's panicking. Instead, we should use his mood swings to our advantage.
Okay.
Buying when he's feeling down,
Yeah.
selling when he's overly exuberant.
Okay.
The key is to have a clear understanding of a company's real worth, its intrinsic value, and to make decisions based on that, not on the market's fleeting emotions.
So we need to be the calm in the middle of the storm.
Yes.
But does that mean that we need to be, financial wizards, constantly crunching numbers?
Sure.
Analyzing data all day?
Yeah, and that's actually where Graham's insight into investor personality comes in.
Okay.
He understood that not everyone wants to be like an active stock picker, right?
Mm-hmm.
He categorized investors as either enterprising or defensive.
Okay.
So the enterprising investor, that's like your detective, constantly digging for clues, researching companies, actively managing their portfolio.
Okay.
They're willing to put in the time and effort for potentially higher returns.
Mm-hmm.
Then you have your defensive investors who prefer a more hands-off approach, focusing on diversification and long-term growth.
Got it.
Think like index funds, simplified portfolio.
Okay, so he's saying there's no one-size-fits-all approach to investing. It's all about figuring out
Exactly.
what works for you.
Yeah, and a key insight he shares is about risk and return.
Okay.
He kind of flips the script
Oh.
on the traditional risk equals return equation.
Mm-hmm.
He says it's not just about how much risk you're willing to take, it's also about how much effort you're willing to put in.
Oh.
He believes work equals return.
Okay.
The more you understand a business, its value,
Right.
what's driving its price, the better your chances of making smart investment decisions and reaping those rewards.
Like that work equals return.
Yeah.
That makes a lot of sense to me.
Yeah.
So it's about rolling up our sleeves and really digging into the details.
Yeah.
But he also recognizes that not everybody has the time
Of course.
or wants to be
Right.
a full-time stock analyst.
Absolutely. He understood that for some people, a simpler, more passive approach is perfectly fine, especially when you consider that consistently matching the market's average return is no small feat.
Right.
He wasn't against indexing at all.
Okay.
However, he did caution against falling into the trap of thinking you can get significantly above average returns with minimal effort.
Right. It's tempting to think that there's a shortcut
Yeah.
to riches, but I guess he's saying there's no free lunch.
Exactly.
When it comes to investing.
No free lunch.
You got to put in the work.
Exactly. And that actually leads us to one of the most crucial concepts in Graham's investment philosophy, the margin of safety.
Okay, break it down for us.
Yeah, so think of it as a financial cushion,
Okay.
It's like having airbags in your car.
Mm.
It protects you from bumps in the road, those unexpected twists and turns, like maybe making a mistake in your valuation or dealing with like sudden market fluctuations.
Right.
So Graham's big idea was to buy stocks at a discount to their intrinsic value. This difference, this discount acts as your margin of safety, helping to minimize your downside risk.
Okay, I'm getting the concept, but can you give us like a real-world example
Sure.
so I can really grasp it?
So let's say you've done your research.
Yeah.
You believe a company is truly worth $50 per share.
Okay.
But right now it's trading at $35.
Okay.
That $15 difference
Yeah.
is your margin of safety.
Got it.
It means that even if your valuation is a bit off, even if the market throws a curveball, you've got some breathing room.
Yeah.
You're not buying at the top hoping for the best.
Right.
You're
Right.
buying with a built-in buffer.
I love how this principle can be applied beyond in engineering.
Oh, yeah.
You know, when they're building a bridge, they build it to withstand forces way beyond
God.
what it's probably ever going to experience.
Yeah.
Or how about Captain Sully
Oh, yeah.
when he landed that plane in the Hudson?
Yeah.
You know, his years of experience, quick thinking, gave him that margin of safety.
Exactly. It's about recognizing that, like, unexpected things can happen. And having that extra buffer, that margin of safety, can make all the difference.
Yeah.
Even in personal finance, having an emergency fund is a form of margin of safety.
Right.
It protects you from, like, unexpected financial shocks.
So whether we're talking about bridges or airplanes or our own personal finances,
Yeah.
having a margin of safety
Absolutely.
just makes good sense.
It does.
But how do we find these companies that are undervalued? Where do we even start?
So Graham actually laid out 7 specific criteria to help pinpoint these potentially undervalued companies.
Okay.
And while we don't have time to unpack all 7 right now,
Yeah.
the core idea is to analyze a company's financial health,
Okay.
its stability, debt levels, earnings growth, and then compare those metrics to its current market price.
Right.
Are those numbers lining up? Or is there a disconnect suggesting that the market might be undervaluing the company?
So we're looking for companies where the numbers tell a different story
Yes.
than the current price tag.
Precisely. And, while Graham really emphasized these quantitative metrics, modern value investors often layer in qualitative factors as well.
Like what kind of factors?
So we're talking about assessing things like a company's competitive advantage, its moat.
Okay.
Can this company fend off rivals and maintain its profitability?
Right.
We also want to look at the quality of its management.
Mm-hmm.
Are they competent, ethical, aligned with shareholder interests?
Right.
And of course, we can't ignore those long-term industry trends.
Right.
Is this company operating in a space that's poised for growth, or is it headed for obsolescence?
Yeah, so we're not just looking at the numbers. We're
Yeah.
trying to understand the whole picture,
Exactly.
the story behind the company.
The story behind the company, 100%.
But can Graham's principles be applied globally, or are they specific to a particular market?
That's a great question. So Graham's principles are fundamentally sound and can be used to evaluate companies anywhere in the world. However, it's essential to consider those country-specific risks. Things like political stability, currency fluctuations, and, those sometimes tricky regulatory environments.
Right.
And accounting standards can be wildly different from country to country.
Right.
So we need to adjust those metrics to ensure we're making those apples-to-apples comparisons.
So it's about understanding the nuances of each market.
Yeah.
And adapting our approach.
100%.
Okay, so let's talk about the guy who took Graham's principles
Okay.
and turned them into a legendary investment career.
Yeah?
Mr. Warren Buffett.
Warren Buffett.
How did he take those teachings and make them his own?
Yeah, so Buffett's early investing style was straight out of the Benjamin Graham playbook.
Okay.
He was all about finding those cigar butt companies.
Okay.
These deeply undervalued, statistically cheap businesses that maybe had one last puff left in them.
Okay.
But as his capital base grew,
Yeah.
he began to shift his focus to higher quality businesses, companies with those enduring competitive advantages, those moats that we talked about.
So instead of just looking for the quick bargain buys, he started seeking out companies built to last.
Yes.
Ones that were going to be around for a long time.
Exactly.
Thrive in the long run.
You got it. And this shift from cigar butts to quality
Yeah.
marked a significant evolution in his approach.
Okay.
He started to realize that as his investments grew, he couldn't just keep hunting for those one-off bargains.
Right.
He needed companies that could scale alongside his capital.
Right.
Instead of seeking quick flips, he embraced a longer-term perspective
Right.
aiming to hold those high-quality companies forever, as he famously put it.
Holding them forever.
Forever.
That's a bold statement.
It is.
But wouldn't that limit his flexibility
Sure.
to adapt to market changes?
Yeah, that's a fair point.
Yeah.
And it's interesting to consider, like, why he made that shift. You see, as Buffett's assets under management skyrocketed,
Yeah.
he recognized that the cigar butt approach, while effective for smaller sums, wouldn't allow him to deploy capital on a larger scale.
Okay.
He needed companies that could not only withstand market shifts, but also capitalize on them.
Right. So he was aligning his investment strategy
Yeah.
with his growing
Capital base.
Yeah, capital base.
Absolutely.
And he needed companies that could grow
Yeah.
alongside his investments.
Exactly.
Okay, so did this switch
Yeah.
from cigar butts to high-quality
Sure.
businesses impact his performance?
It's fascinating to look at the data.
Yeah.
So while Buffett's overall track record is phenomenal, studies show that his returns were actually higher during his cigar butt phase.
Oh.
However, those higher returns also came with like a wilder ride, more volatility.
Oh, yeah.
The shift to those high-quality companies,
Yeah.
while maybe delivering slightly lower returns overall, also brought more stability to the portfolio, potentially reducing the risk.
So it's a classic trade-off,
Yeah.
higher returns.
Higher potential returns.
Yeah, potential returns, but a little bit more of a roller coaster.
To volatility, yeah.
And then
Yeah.
maybe slightly lower returns, but a smoother ride.
More consistent.
Yeah, more consistent.
Feels
That
completely-
makes you think about your own risk tolerance.
Absolutely. It underscores the importance of understanding your own investment goals, your appetite for risk, and your time horizon.
Right.
What's right for one investor might not be right for another.
Yeah.
And it's important to note that even though Buffett evolved his approach, he never strayed from Graham's core principles, especially, though, that focus on the margin of safety, a disciplined investment process, and recognizing that the market can be driven by emotions rather than logic.
So even though he switched up the types of companies that he was investing in,
Yeah.
the underlying principles
The principles remain.
remain the same.
Exactly.
Okay, and that brings us to another one of Graham's insights
Okay.
that can kind of help us understand why investors sometimes
Yeah.
make these irrational decisions. And that is this idea of probability matching.
Probability matching.
Okay, so what is that and how does it affect us as investors?
So have you ever noticed how, people tend to look for patterns even in random events? They start to believe they can predict outcomes when there's no logical basis for it.
Yeah, like with the market.
Exactly.
Clocks on that.
It happens to the best of us.
Yeah.
So think about how, investors often repeat mistakes despite knowing better. They chase hot stocks,
Yep.
get swept up in the hype panic, and sell at the worst possible time.
Right.
A lot of this behavior stems from probability matching, trying to find these non-existent patterns in the market's chaos and believing they can somehow outsmart it.
Right, so they're basically chasing ghosts.
Chasing ghosts.
Instead of relying on a solid understanding of a company
Yeah, right.
and their value.
100%.
Yeah.
And Graham was keenly aware of this human tendency. He knew we're emotional creatures, and those emotions can cloud our judgment, especially when money's involved.
Right.
He believed that the best investment advice is not necessarily the theoretically perfect one, but the one that's psychologically practical.
Okay.
It's not just about what we should do, but what we can actually do given our own temperament and biases.
So investing isn't just about understanding the markets. It's also about understanding ourselves.
Absolutely.
Our own psychology.
Oh, 100%.
So given all of that, given Graham's insights into market psychology and the enduring power of his principles,
Sure.
how can we apply all this
Yeah.
to navigate today's crazy, ever-changing market?
That is the question, isn't it?
Yeah.
And I think Graham would urge us to remember that his principles, they aren't like rigid rules set in stone.
Right.
They're more like a flexible framework for thinking about investing. The exact metrics he used decades ago might need some tweaking
Right.
today's market, but those core concepts, they're still the foundation.
So we need to adapt the principles
Yeah,
to fit the current context,
exactly.
not blindly follow those outdated formulas.
Right. It's like having a vintage car. We might need to swap out some parts to keep it running smoothly.
Right.
But the classic design
Yeah.
still holds up.
So, for example, those statistically cheap nets that he loved.
All right.
Companies trading for less than their liquidation value?
Right.
We don't see that as much anymore.
Not as easy to find these days.
Right. But that principle of buying below intrinsic value,
exactly,
still very relevant.
100%. So how do we put that margin of safety principle into action in today's market?
Yeah, what are some concrete steps that we can take?
Right. So first and foremost, Graham would tell us to really get to know the businesses we're thinking about investing in.
Okay.
And that means going deeper than just glancing at price charts or listening to the latest market gossip. We need to roll up our sleeves, delve into those financial statements, understand the competitive landscape, and really size up the management team.
So there's no substitute for good old-fashioned research.
Exactly.
Right. And wasn't that what he meant by work equals return?
100%.
The more effort we put into understanding the business,
the
better our chances of making those good decisions.
Precisely. And let's be realistic, we're not going to become financial analysts overnight.
Right.
So start by focusing on a few companies that truly pique your interest.
Okay.
Maybe it's an industry you're familiar with or even products you use every day.
Right.
As you learn more, you'll gain the confidence to apply Graham's principles to your own investing decisions.
Okay. That makes it seem a lot less daunting.
Yeah.
Start with what you know, what interests you, and build from there.
Absolutely.
Okay, but what about those emotional traps that he warned us about?
Yeah.
How do we make sure that we don't get swept away by Mr. Market's mood swings, especially when everyone around us is getting caught up?
Absolutely, and that's where the intelligent part of the intelligent investor comes into play. It's about developing that self-awareness, acknowledging that we're all vulnerable to those emotional influences, and putting safeguards in place to prevent those emotions from leading us astray.
Okay, I like that.
Yeah.
So what are some specific safeguards that we can put in place?
Yeah, so a well-defined investment plan
Okay.
is crucial. It's like having a roadmap for your investment journey.
Okay.
Outlining your goals, your risk tolerance, and your time horizon.
Yeah.
This plan becomes your anchor,
Okay.
guiding you through the inevitable storms and preventing you from making those impulsive decisions.
So we're pre-committing
Yes.
to the plan.
100%.
Before
Until things get crazy.
Exactly. And having a checklist can be incredibly helpful too.
What do you mean?
Think of it as a set of criteria you use to evaluate every investment opportunity.
Okay.
This checklist, based on Graham's principles, acts as a filter.
Helping you separate the wheat from the chaff and focus on those investments that truly align with your requirements.
So we have these objective measures in place to evaluate every opportunity.
Exactly.
Okay, and how do we apply that Mr. Market concept to our decision making?
So remember, Mr. Market is that emotional fellow who's constantly offering you prices.
Right.
Sometimes those prices are irrationally high. Sometimes they're ridiculously low.
Right.
The key is to not let him call the shots.
Okay.
Think of him as a source of information.
Okay.
Someone who can give you insights into market sentiment, but don't let his mood swings dictate your actions.
Right. So we need to block out the day-to-day noise.
Yeah.
And focus on the fundamentals.
Focus on the fundamentals.
The long-term trends.
Absolutely.
Okay, so if we've done our homework.
Yes.
If we know what the intrinsic value of a company is, and Mr. Market is giving us a really good price, that's a good opportunity to buy.
That's a good sign that it might be a good time to buy.
And if he's offering a price that's way too high, then maybe it's time to sell.
Maybe it's time to sell, or at least reevaluate your position.
Okay.
Yeah.
So we're turning the table.
Turning the tables.
On Mr. Market.
Exactly.
But doesn't this require a lot of patience?
Absolutely. Patience is one of the most valuable traits an investor can cultivate. It's about resisting that urge to chase quick profits and focusing on building wealth over the long haul.
It's a marathon, not a sprint.
It's a marathon, not a sprint.
Okay, but it's hard to be patient when it seems like everyone else is making a killing by jumping in and out of the market.
Yeah, and that's where self-awareness and discipline come in.
Okay.
It's crucial to recognize that the market often rewards short-term speculation.
Right.
Creating this illusion that, like, quick riches are easy to come by.
Yeah.
But remember, those who are chasing those quick gains are often taking on a lot of risk.
Right.
And they're more likely to get burned when the market inevitably shifts.
So they're playing a dangerous game.
Very dangerous game.
Yeah. So we need to avoid following the crowd.
Absolutely. We need to stick to our own plan.
Right. It's like we've got a map and a compass,
Yeah.
and they're just running around in circles.
Exactly. That's why having a well-defined investment plan and a checklist based on sound principles is so crucial.
Mm-hmm.
They're your anchors keeping you grounded when the market gets stormy.
Yeah, so it's not about getting rich quick.
Yeah.
It's about building sustainable wealth.
It's about building sustainable wealth over the long term.
Yeah, over the long term.
Exactly.
Now, Graham also emphasized the importance of capital preservation.
Oh, absolutely.
Like
Yes.
protecting our investments from those big losses.
Yeah.
That seems especially important now.
It is.
Markets are volatile.
Volatile, yeah. Remember that margin of safety we talked about?
Yeah.
It's all about minimizing your downside risk. It's about making sure that even if you're wrong about a company, even if things don't go as planned, you're protected from those catastrophic losses.
So it's like having airbags
Airbag
for our portfolio.
for your portfolio, exactly.
Okay.
And that cushion comes from buying assets for less than they're worth,
Mm-hmm.
diversifying your holdings,
Right.
and avoiding that unnecessary risk.
Okay, so it's about being smart and calculated,
Smart and calculated.
not reckless.
Not reckless.
But how do we know what level of risk is right for us?
Right.
Because that seems like a very personal decision.
It absolutely is. There's no one-size-fits-all answer
Yeah.
when it comes to risk tolerance.
Right.
It depends on a lot of factors: your investment goals,
Yeah.
your time horizon,
Mhm.
your financial situation, even
Yeah.
your own personality,
Yeah.
your comfort level with volatility.
So we've got to find that sweet spot.
The sweet spot.
Yeah. Where we can participate
Yeah,
in the growth of the market, but not be losing sleep at night.
exactly. We don't want to be so risk-averse that we miss out on opportunities, but we also don't want to be taking on unnecessary risks that could keep us up at night.
Right. And that can change over time.
It absolutely can.
Yeah.
Your risk tolerance is not static.
Yeah.
It can
Yeah.
change as you gain experience, as your financial situation evolves, and as your investment knowledge expands, your comfort level with risk might also shift.
So we need to be adaptable.
Adaptable.
Reassess periodically.
Periodically reassess.
Yeah, and adjust our approach.
100%. The key is to be honest with yourself about your risk appetite and to build a portfolio that aligns with your comfort level.
Yeah.
And remember, Graham emphasized that even the most seasoned investors make mistakes. The margin of safety is there to protect us from those inevitable errors in judgment.
So investing is a journey.
It is.
It's a continuous learning process.
100%.
And we're not always going to be right.
You're not going to be right all the time.
We're going to make mistakes.
You're going to make mistakes.
But it's about having that framework in place
Yeah.
to protect us,
Protect us.
minimize our risk,
Minimize the risk.
and keep learning
Keep learning. Exactly.
along the way.
Along the way. And, I think Graham would also encourage us to be skeptical
Yeah.
of those who claim to have all the answers.
Right.
He was a big believer in independent thinking and doing your own research and in developing your own judgment based on sound principles.
Yeah, so we shouldn't just blindly follow
No.
expert or the crowd.
Exactly.
We need to develop our own critical thinking skill
I think cooking.
and make decisions based on our own analysis.
Based on your analysis, 100%.
So we're taking ownership
Ownership
of our investment decision.
of your investment decisions, exactly. And remember, the market is often driven by fear and greed,
Right.
leading to those irrational price swings we talked about.
Mm-hmm.
By developing our own independent judgment, we can avoid getting caught up in that emotional roller coaster. We can become more like Mr. Spock, making logical decisions based on facts and analysis rather than getting swept away by the market's emotional whims.
I like that.
Yeah.
Mr. Spock.
Mr. Spock.
Very logical.
Very logical.
Not emotional.
Not emotional at all.
Okay. Now, we've talked about how Graham evolved
Yeah.
as an investor.
Mm-hmm.
He went from those cigar butts to those high-quality businesses.
Right.
Did he ever completely abandon?
That's a really interesting question.
Yeah.
So while he definitely shifted his focus to those higher quality companies, I don't think he ever fully abandoned his cigar butt roots.
Okay.
Remember, he always advocated for buying assets below their intrinsic value,
Right.
and he recognized that there were still opportunities to be found in those undervalued, statistically cheap businesses.
So one approach wasn't necessarily better than the other.
Exactly.
He was just recognizing that both could work.
They could both contribute to building a successful portfolio.
If applied thoughtfully.
If applied thoughtfully and strategically.
Right. So this really highlights
Yeah.
the fact that his philosophy was Adaptable.
It wasn't about rigidly adhering to a single approach,
Right.
but rather about adapting his principles to fit the current market environment and his own evolving investment goals.
Yeah, he was flexible.
Yeah.
He was willing to adapt and adjust as needed.
Exactly.
Okay, but there's so much information out there.
There is.
How do we even begin to apply his principles to our own research?
It's true, the information overload can be overwhelming.
Yeah.
But remember, Graham emphasized focusing on a few key metrics.
Okay.
Understanding a company's financial health and comparing its current price to its intrinsic worth.
Right.
Those are the core elements.
So instead of getting bogged down in all the tiny little details, we need to focus on the things that are most important.
The most important metrics, the ones that are truly relevant.
Right. So we're finding the signal.
The signal.
In all the noise.
In all the noise, 100%. And you know, this is actually where technology can be a huge help.
Okay.
There are so many online resources, financial websites, and investment platforms that provide access to the data and the analysis you need to apply Graham's principles.
Okay.
They can help streamline your research and focus on those key metrics.
That's encouraging. So even though the markets become more complex, the tools that we have as investors have also gotten better.
Absolutely. We're not at a disadvantage.
Yeah.
Just because we don't have like a team of analysts at our disposal.
Right. And remember, Graham was all about independent thinking.
He was.
He didn't want investors to blindly follow him.
No.
Or any other expert for that matter.
Yeah.
He wanted investors to develop their own judgment.
Their own judgment.
To be skeptical of the crowd and make decisions based on their own analysis.
Based on their own analysis, 100%.
Okay, so with all this information coming at us, opinions, predictions, constantly flowing, how do we stay grounded?
It can be a lot.
How do we avoid getting swept away by the latest trends?
Discipline and focus are essential.
Okay.
It's about having a clear set of criteria based on Graham's principles to filter out that noise and identify those opportunities that truly align with your investment goals.
So we're not chasing hot stocks.
No.
We're not trying to time the market.
Nope.
We're sticking to our plan.
We're sticking to the plan, being patient.
Patiently seeking out those undervalued gems.
Undervalued companies, yes.
Trusting in the long term?
Long-term approach, exactly.
It's a marathon.
Marathon?
Not a sprint.
Not a sprint.
Okay, now Graham also emphasized the importance of capital preservation.
Absolutely.
Right? Yeah. Protect our investments from big losses.
Big losses, minimize those losses, yeah.
That seems especially relevant today.
It is.
Given the volatile market that we're in.
Volatile market, yeah. Remember that margin of safety we talked about?
Yeah.
It's all about minimizing your downside risk. It's about making sure that even if you're wrong about a company, even if things don't go as planned, you're protected from those catastrophic losses.
So it's like having airbags.
Airbags in your portfolio, exactly.
Thank you.
And that cushion comes from buying assets for less than they're worth. Diversifying your holdings.
Right.
And avoiding that unnecessary risk.
Okay, so we need to be smart.
Smart.
Calculated.
Not reckless.
Not reckless.
No.
But how do we know what level of risk is right for us?
Right.
Because, again, that seems like a very personal...
Absolutely. It absolutely is. There's no one-size-fits-all answer when it comes to risk tolerance.
Yeah.
It depends on a lot of factors. Your investment goals, your time horizon, your financial situation, even your own personality and your comfort level with volatility.
Right. We need to find that sweet spot.
Find that sweet spot.
That we can participate in the market, but not be too stressed out.
Exactly. We don't want to be so risk-averse that we miss out on opportunities, but we also don't want to be taking on unnecessary risks that could keep us up at night.
Right. And that can change over time.
It absolutely can.
Yeah.
Your risk tolerance is not static.
As we get more experience.
As you gain experience.
Things change.
Things change 100%.
Our finances change.
Absolutely. As your financial situation evolves, as your investment knowledge expands, your comfort level with risk might also shift.
So we need to reassess periodically.
Periodically reassess.
Yeah, and adapt our
approach. Adapt your approach. Exactly. The key is to be honest with yourself about your risk appetite and to build a portfolio that aligns with your comfort level.
And remember, he emphasized that even the most experienced investors make mistakes.
They do. They do.
It happens
to everybody.
To everyone, even the best.
Yeah.
The margin of safety is there to protect us from those inevitable errors in judgment.
So investing is a journey.
It is.
It's a continuous learning process.
We're not going to be right all the time.
You're not going to be right all the time, no.
You're going to make mistakes.
You will.
But it's about having a framework to protect us.
A framework, yeah.
Minimize our risk And keep learning along the way.
Keep learning along the way, exactly. And I think, Graham would also encourage us to be skeptical of those who claim to have all the answers.
Right. There's no guru.
There's no guru
out there with a crystal ball.
No crystal ball.
Yeah.
He was a big believer in independent thinking, in doing your own research, and in developing your own judgment based on sound principles.
So we shouldn't blindly follow the
expert
or the crowd. We should use our own critical thinking skills.
Yes, use those critical thinking skills.
Yeah, and make decisions based on our own analysis.
Based on your analysis, 100%.
So we're taking ownership of our financial future.
Ownership of your financial decisions, exactly. And remember, the market is often driven by fear and greed, leading to those irrational price swings we talked about earlier. So by developing our own independent judgment, we can avoid getting caught up in that emotional roller coaster. We can become more like Mr. Spock. Making logical decisions based on facts and analysis rather than getting swept away by the market's emotional whims.
Love it.
Yeah.
Okay, so now let's shift gears a little bit.
Okay.
And talk about this concept of market timing.
Market timing.
Did Graham think that it was possible to predict the market's movements?
So Graham was famously skeptical of market timing.
Oh, okay.
He believed that trying to predict those short-term swings was essentially a fool's errand.
Right.
He argued that even the most experienced professionals had a terrible track record of getting it right consistently.
Like trying to predict when lightning will strike.
It's like trying to predict when lightning will strike. It's incredibly difficult, if not impossible.
Okay, so instead of trying to time the market perfectly, he was advocating for a more disciplined approach.
100%.
Right.
He believed that time in the market was far more important than timing the market.
So it's about being in the game.
Being in the game.
For the long haul.
Long haul, exactly.
And not trying to jump in and out.
Jump in and out.
All the time.
No, in other words, it's about consistently investing in quality businesses and letting the power of compounding work its magic over the long term.
Yeah, it's about being a long-term investor.
Long-term.
Not a short-term speculator.
Not a speculator, no.
And recognizing that the market goes through cycles.
Cycles.
We can't avoid those.
You can't avoid them.
Ups and downs.
Ups and downs, they're inevitable.
Yeah.
Precisely. And, Graham recognized that market downturns are a natural part of the economic cycle.
Right.
They've happened before and they'll happen again.
They will happen again.
The key is to not let those temporary declines derail your long-term investment strategy.
Right. So it's like weathering a storm.
Weathering a storm.
We know it's going to pass.
We know it will pass.
Eventually. Yeah. But we need to make sure our portfolio is strong enough to withstand it.
To withstand those turbulent periods, exactly.
So we're not going to avoid losses altogether.
Right.
But we need to manage
those risks.
Effectively.
Effectively, yes. And I think Graham would also encourage us to be opportunistic.
Oh, okay.
During those market downturns.
What do you mean?
Remember, he viewed them as potential buying opportunities.
Okay.
A chance to acquire undervalued assets at a discount.
Okay.
It's like going shopping during a clearance sale.
Yeah.
You can find some great bargains if you're patient and know what to look for.
So when the market drops,
yeah,
we shouldn't panic.
Don't panic.
We should look at it as an opportunity.
As a potential opportunity to buy low.
To buy low.
And potentially enhance your long-term returns.
Yeah. So we're taking a contrarian approach.
Contrarian approach, yes.
Exactly.
But that takes courage.
It does.
Courage.
It does require some courage and conviction to go against the grain.
Yeah, because it's hard to go against.
Yeah.
It's what everyone else is doing. It is. And, Graham was a strong advocate for independent thinking.
Right.
He believed that the crowd is often wrong and that those who are willing to think differently can often find the best opportunities.
Be in the minority.
Be in the minority sometimes. Yeah, he wasn't afraid to go against the tide if his analysis told him a different story.
Yeah, so we need to trust our own judgment.
Trust your own judgment.
Even if it's different.
Even if it's different.
Than the consensus.
Than the consensus, exactly.
Yeah.
But, we should also be smart.
Yeah.
Be disciplined and make sure our decisions are based on sound analysis, not just blind contrarianism.
Right. So we're not just being contrary.
No.
To be contrary.
Not for the sake of being contrary.
We're doing it because our analysis.
Because your analysis tells you.
That's the right move.
This is the right move, exactly. And remember, Graham wasn't advocating for reckless contrarianism. He emphasized the importance of basing our decisions on solid principles, on thorough analysis, and on a deep understanding of the businesses we're investing in.
We need to do your homework.
Do your homework. Exactly. It's not about being contrary for the sake of being contrary. It's about having the conviction to act on your own research and to make decisions that align with your long-term investment goals, even when those decisions differ from the prevailing market sentiment.
So investing is not a game of chance.
No.
It's about allocating capital wisely.
It's a process of carefully allocating capital, managing risk, and building wealth over the long term.
But how do we develop that long-term perspective?
Right.
When there's so much noise.
Yeah. Sure, it's like trying to read a book in a room full of screaming children.
Right.
It's hard to stay focused.
Yeah, all these distractions.
All those distractions. Yeah, that's where having a clear investment philosophy, one that's grounded in sound principles, becomes so crucial.
Okay.
It's about having like a set of beliefs that guide your decision-making, helping you to filter out that noise and stay focused on what truly matters.
So we have a compass.
A compass.
To keep us on course.
Exactly, to keep you on course, even when the market throws those inevitable curveballs.
We know where we're going.
You know where you're going.
And how to get there.
How to get there, exactly. And, Graham's principles provide a solid foundation for building that investment philosophy.
Right.
They emphasize the importance of value, of margin of safety, of discipline, and of independent thinking.
Yeah.
These are the cornerstones of a sound approach to investing.
So we're not following the trends.
Yeah.
We're not chasing hot stocks.
No chasing hot stocks, no.
We're developing a sound approach.
A sound approach.
And sticking to it.
Sticking to it even when the market gets turbulent.
Through thick and thin.
Through thick and thin, yes.
So marathon, not a sprint.
A marathon, not a sprint. And, having a checklist.
Yeah.
A set of predetermined criteria to guide our investment decisions can be so helpful. By having a checklist based on sound principles, we can remove some of the emotion from the process.
Right.
And make more objective choices.
So it's a set of rules.
A set of rules.
That we've pre-committed to.
Pre-committed to.
So that when things get emotional.
Yeah, when emotions are running high.
Yeah.
You can take a step back and let logic and reason guide your actions rather than getting caught up in the heat of the moment.
Right.
Exactly. And this checklist can be based on Graham's principles.
Okay.
Such as looking for companies with strong financials, low debt levels, consistent earnings growth, and a history of paying dividends.
Right.
These are the hallmarks of well-managed, financially sound businesses.
So we're being more rational.
More rational.
More disciplined.
More disciplined, yes.
But we're going to make mistakes.
You are.
It's going to happen.
It's going to happen.
Well,
Even the most experienced investors make mistakes.
Yeah, so how do we deal with that?
So Graham acknowledged that no one can be right all the time. That's why he emphasized the importance of having a margin of safety built into every investment.
So we've got a buffer.
A buffer to protect us. To protect you, exactly. The margin of safety is there to absorb those losses and prevent them from derailing your long-term investment goals.
So investing is a learning process.
It is.
It's ongoing.
Ongoing.
We're going to make mistakes.
You will.
We need to learn from them.
Absolutely.
And keep moving forward.
Keep moving forward 100%. Right.
And we need to make decisions based on, solid assessment of the facts and our own analysis.
Based on the facts and your analysis, yes.
We can't let our ego get in the way.
Ego can be a dangerous thing in investing.
Yeah, for sure. And that brings us back to, I think, one of his most fundamental messages, the intelligent investor.
Yes.
Isn't the person with the highest IQ
right.
or some magical ability to predict the future?
Exactly. It's about temperament. It's about patience, discipline, and a commitment to lifelong learning.
Yeah, it's about the mindset.
The mindset.
More than anything.
More than anything, 100%.
So this whole deep dive has been so insightful. We've covered so much.
Yeah.
What would you say is the one key takeaway that you want our listeners to walk away with?
That's a great question. I think if I had to distill it down to one essential point, it would be this. Graham's teachings offer us like a framework for thinking about investing, a roadmap for navigating the complexities of the market while staying rooted in logic and sound principles.
I like that.
Yeah.
So it's a roadmap.
A roadmap.
To help us navigate this crazy world.
This crazy world of investing, yes. And it's about, recognizing that investing isn't about getting rich quick, but rather a long-term process that requires patience, discipline, and a commitment to continuous learning.
So for our listeners out there who are eager to learn more
Yeah.
and really start putting these principles into practice, what would be a good first step for them?
I would strongly recommend exploring Graham's own writings,
Okay.
especially his book, The Intelligent Investor.
Yeah.
It's considered the Bible of value investing for a reason.
It's a classic.
It's a classic. It lays out those core principles in a clear, accessible way that's still relevant today.
So go straight to the source.
Straight to the source.
Yeah, and I would add to that, as you're reading it, don't just passively, consume the information.
Right.
Really engage with it.
Engage with it.
Think about it.
Think about it.
Challenge it.
Challenge it.
Question it.
Question it. Yeah.
And see how it applies to you.
Absolutely. Investing is a personal journey.
Mm-hmm.
And finding your own approach guided by those sound principles is the key to long-term success.
Right. So it's not about following the rules blindly.
Yeah.
It's about taking those principles
Taking the principles.
and figuring out how they work for you.
Exactly. And remember, the world of investing is constantly changing. So stay curious.
Keep learning.
Keep learning and never stop seeking out new knowledge and perspectives.
Absolutely. We can't just, rest on our laurels. We got to keep learning and adapting.
Keep learning, keep adapting, 100%.
Well, this has been another great deep dive.
It has.
I hope you found this exploration of Benjamin Graham's wisdom as insightful as I have.
Me too.
And until next time, keep those minds sharp, keep those curiosity levels high, and as always, happy investing.